So far, we've looked at market profile value area and TPO date types. And now it's time to put an icing on the cake and learn about time frame transitions, which is the final part of market profile I teach in my courses. There are a few other components of the market profile, such as day open types, which involves trading the Wall Street open. But a lack of liquidity and investor nervousness in the markets due to the current geopolitical situations that now seem to come up every year. And these are the events that, previously used to happen every 20 years or so. And all of that has actually made that first hour of the trading day incredibly noisy with a really tight range. And like any strategy, market profile needed a few tweaks to reflect the slightly different situation. And as a part of that, I've excluded the day open types from this course because the average daily ranges are incredibly tight when you compare them historically. Now, through our backtesting, these open types have also failed to produce any meaningful results. They have failed at consistency and profitability. And here in Market Stalkers, with the help of Blatek algorithms, we have a unique ability to test the theories and different strategies. And what I teach in these courses is only strategies that have been proven by my own forward testing and trading over the last 6 years. But it's also strategies that have been successfully translated into algorithms. We've been working on the main financial algorithm since January 2015. Currently, Blatek are working on different components of the algorithm, and at the time of me recording this course, which is now April 2016, it is still work in progress. I mean, it's a huge project and we expect to probably have it finished by the end of 2016 or at the latest by mid-2017. So all of my strategies and the way I trade are coded into this algorithm, okay? And that is what I'm teaching. I'm teaching you high probability setups that have been proven. Okay, so with that little background concerning the reasons of why the day open types are not included here, let's start with part 3, market profile, time frame transitions. Time frame transitions. So what are they? Time frame transitions can actually show you who is creating the activity that you're seeing on the chart. Is it the market makers who make their money through commissions and volume of trades and whose interest really only lies in placing as many positions as they can? Or is it the institutions who are actually looking for suitable longer time frame areas where they perceive the market to be too high or too low and they wish to capitalize on that, and who are able to truly move the markets due to the size of their positions? So on the agenda in this lesson is a revision of what initial balance is. We're going to go through the range extensions as well. We looked at these in the previous lesson. We're going to read the aggressiveness or lack of aggressiveness of market participants. And finally, we have bracketing versus trending markets. What to look out for. In another way, it's looking at whether the market is ranging or not. So bracketing is another word for ranging. And finally, we have transitioning from day time frame to other time frame participants, locals versus the institutions. So to quickly revise, what is initial balance? Initial balance is the first hour of trading when the market participants attempt to find a range where a two-sided trade can take place. And it is represented by the red letters on our Blatek market profile indicator. And it's marked as A and B letters. Now here's the new part. Initial balance is created by locals who represent market makers that create liquidity, not direction. The locals, they make their money by taking commissions from clients. So it's in their interest to keep placing the trades. It's stockbrokers, right? They're not there to move the market in any particular direction. They're just there to fill the positions that their clients are looking at. Locals moves are considered responsive activity. Remember this. This responsive activity is also referred to as the day time frame. We also use initial balance to possibly guess a day type, which you should already know from the previous lesson. And that can give us an indication of what kind of a day we're looking at. And using this information, you can quite accurately predict where and how the market might go. Then we have range extensions. Now these are always created by the other time frame participants who represent hedge funds and central banks and other institutions who have no desire to make loads of trades. It's quite the opposite. They're looking to get in on trades that will enable them to stay in the market for longer periods of time. 1 month, 3 months, 1 year. It's asset allocation. Okay? So it stands to reason that those other time frame participants will be looking for vastly different levels than the locals. Other time frame participants are visible through initial balance extensions. So they're the ones who always extend the initial balance. Okay? As soon as the initial balance is extended, that's the institution stepping in. And then if you have a sustained move that holds outside of the initial balance range, that gives you a very good idea of the intention of the institution, so there's no guessing. Therefore, if we know that we want sustained reaction away from initial balance, it is logical to presume that the return into initial balance following the break is an unfavorable price action if you're looking to get in on a swing trade. Other time frame participants are also the ones responsible for something called the initiative buying or selling activity. Okay? So you have responsive activity that is created by the locals, and now you have initiative activity. Remember those two terms. You will need them. So therefore we have a concept of locals who trade the day time frame, creating responsive activity, versus the other time frame participants who create the initiative activity clearly visible on the profile. When the initial balance range gets extended, that means that we can possibly guess what kind of a day type we have. So it's all coming together now. This, coupled with the location of medium time frame supply and demand zones, Q points, and the value area from the previous trading day, will start to give you a very clear picture of what is going on behind the scenes. Okay? Then we have reading aggressiveness versus the lack of aggressiveness of those market participants, because there is a way to see whether the institutions, i.e. the other time frame participants, are aggressively stepping in or not, way before you see the move in one sustained direction. And the way we do that is when prices probe either below or above initial balance, there are two possible things that might happen. Either the market is going to find buyers or sellers and continue in the direction of initial balance break, causing a sustained move, or two, it will fail to find business and it will return to initial balance range. So in the case that they find business outside of initial balance, we want to see a sustained move in the same direction, which can be then read through candlesticks on a 30-minute chart. And this is where your price action skills should come into a very good use. If you get a Marubozu candle, that implies that the break of initial balance is confident and strong, and you expect the direction to continue. What usually happens when you have a move, sustained move of initial balance break, you will typically then get a creation of a brand new conterminous line. Now, it might be a demand or a supply, depends on which way they've taken it. But usually when you get a sustained move that then creates a new conterminous line, we can then use that conterminous line the next day to possibly get in on the move, because prices always return to conterminous lines. I mean, not always, but let's say 80% of the time, you will get a test of a conterminous line, and we've done that too. Return to the conterminous line is the norm, so use that. If you see a break outside initial balance, and then you have a brand new conterminous line and you're not in a trade, use a pullback to the conterminous line to get in. So upon the break of initial balance, other strong candlesticks are obviously also acceptable. I'm not always going to be looking for a Maribozu candle. So let's say if the price falls below initial balance via a shooting star or maybe a confident bear candle without much of a lower wick, that is also a sign that the direction is likely to continue. But you would still wait, if you're not in a trade already, you would still wait for your entry from a pullback into a conterminous line. This is my favorite way to get in on trades. The move happens, they pull back to a recent conterminous line, and then I get in. That is actually called a second chance entry, and we will do this in level 3 a lot. But for now, just know that you can use the newly formed conterminous lines even on a 30-minute chart and a 15-minute chart, 1-hour chart. It works intraday as well. Now going back to the initial balance, just purely by looking at market profile, what frequently happens is that price will go back to test the edge of initial balance once it's broken it, okay? And especially during the first half hour to an hour following the break of initial balance. And this is where the end of the previous lesson comes in, because if you already had a significant extension, you will have all these extended single tick TPOs during a particular half-hour period. If you remember the end of the last lesson, I was talking about single tick TPOs. But should the price fail and it starts to take out those TPOs, let's say we've broken the initial balance to the upside, and then suddenly you have all these single tick letters, and then maybe 2 or 3 letters at the top, and then we start to track back through the single TPOs. Now, that is a sign that whoever bought or sold, but let's say bought for simplicity, so whoever bought is no longer around. And now we have market participants with other ideas. They're perceiving this price to be way too high. This kind of behavior also can mean that there's a profit-taking move happening. Okay? If you cannot remember exactly what I'm talking about when I'm talking about single TPOs, please go back to the previous lesson and revise the end of it. I talk about this. Now, that brings me to the next slide. This is scenario B, where price fails to find business outside of initial balance. So up until now, we were talking about price finding business outside of initial balance and having a sustained move. But what happens if the price fails to find business? Well, there you will also have single TPOs, but in this case, should they occur in the next hour that the initial balance was broken, they will leave a so-called tail, which implies that the other time frame participants have failed to find business, and price will return back to initial balance. Now, this tail is also comprised of single letter TPOs. The more single TPOs you have in a tail, the more aggressive the other time frame participants are. For example, we have a strong selling tail, and there's no confusion here. If the tail is at the top, that means they're selling. If the tail is at the bottom, that means they're buying. The more single TPOs you have in a tail, the more aggressive the other time frame participants are to the opposing side. So the longer the tail, the more aggressive they are. However, listen very carefully, because this is where people trip up a lot. In order for a tail to be valid, you have to wait for another half-hour period after it first breaks the initial balance to make sure that you are staring at a potential tail. Now here in this particular example, you see that the price has broken the initial balance to the upside and it's created an extension and a selling tail during C period. But notice that until the D period, we won't know whether this is an actual break of initial balance or merely a retest before the price goes higher. If the price goes higher, that will invalidate the tail. Therefore, you have to wait for the end of the next half-hour period, and in this case, that is period D, before you can confirm the tail. This is where reading price action comes in handy. Knowing what is around the levels where the C period has extended into, is there supply there? Is there maybe a Q high from a medium or a larger time frame? Did the price create a shooting star? Because in case that this pops to the upside was indeed a true extension of the initial balance, but you jumped into short during the C period and then the price slowly starts to track back through this selling tail, giving you this kind of a view. Oh dear. See? So if the selling tail isn't coming from a previously designated zone for possible reversal that you've marked, and then the trader gets a little bit overexcited to recognize a selling tail, but doesn't wait for the end of the next half-hour period, in absence of the correct chart position and a swing extreme, the trader is now panicking that they've made a mistake, not waiting for the end of the D period. So you are now staring at the invalidation of the entire selling tail due to a sustained move upwards. So be aware of that. Make sure that your selling and buying tails are coming from your previously designated areas for potential reversals that are carefully planned out and not just sort of gung-ho, trigger happy, I'm seeing a selling tail type trades. I'm going to remove my face now so that you can see the profiles here. Okay, so here are a couple of practical scenarios of both events. This first one is a break of initial balance to the downside and then a failure to find sellers. So, let's say that we're talking about a break of initial balance to the downside. If the candle ends with a large lower wick, this indicates that the buyers are around. So this is where you can start to combine a profile with price action. The longer the wick, the more buyers are fighting back. So this is a DAX chart. So first things first, let's analyze this to death. Price, this is the Wall Street Open. So price opened below value area, which at this time is actually counter trend to the current prevailing trend on medium time frames. So right away, you need to check if around this area, whether there's some kind of a Q point or that a daily or a 4-hour supply could possibly be causing this. Just as it happened, there were no Q points here. If you look carefully, the price actually opened almost inside range because this is your previous day's range, okay? Therefore, the imbalance that we're seeing here isn't too strong. So at this point, we don't have a clear picture yet, apart from the directional bias due to the bearish open. Now, the bearish open, when you get an open below value, that already indicates initiative activity, okay? So, initiative activity is other time frame participants. It is the institution stepping in. So just by Wall Street opening below value, that already implies some kind of initiative activity. And then the break of initial balance does happen in this D period, okay, which is this candle here, okay? and that is a second hour of trading. And then pretty much right away, if you look on the profile, the buyers stepped back in and pushed the price back confidently into initial balance, creating an okay buying tail. And not only that, but they carried on pushing the price all the way through. Look, it went all the way through. And then eventually they even extended it to the upside. So now two things have happened. You do have a buying tail, but it's not particularly aggressive. It's an okay buying tail. However, you've extended upwards as well, and now you're looking at a possibility of a neutral day type. Now, I've noticed a lot of the times when buying and selling tails occur on the profile, and then the price kind of confidently extends the initial balance to the other side, it might actually continue to create something that resembles a normal or a normal variation day. In your traditional market profile rules, according to Jim Dalton, he says that as soon as you've had an extension of profile to one side, that you should immediately then expect a neutral day should we extend it to the other side. But here's another tweak to the market profile rules. If you have a very aggressive selling or buying tail that is coming straight from the initial balance, should the prices go back through the initial balance range and extend to the opposite side, this is not an expectation of a neutral day. Now, you do have to combine this with the average daily range as well, because if you've had an extension of balance and then you have a relatively small initial balance, and then you have an aggressive buying tail, and then we just continue straight through, and there's plenty of ADR to the upside before you even consider that the day might be over. Well, in that case, I would say that you're not looking at a neutral day, but you're actually looking at initiative buying and picking up some orders in order to push the momentum higher. So a pure buying or selling tail as it's coming out from the initial balance without having any further letters apart. Like for example, here you only have the D letter. But if you had D, E, and F, and then maybe you had a buying tail that happened in F period, but you still had an extensions below the initial balance throughout the D and E period, then you can expect a neutral day. But if you only have one letter that popped down below or above initial balance, but if you only have one letter that popped out of initial balance, in that case, there is really little chance that you're all looking at a neutral day. I would say that you're looking at a sort of a hybrid day where you will probably end up having a normal or a normal variation day in the end. But only if the buying tail is aggressive and if you've not exhausted the ADR. So you have to combine, like trading is all about combining all of these different ideas and different informations and then chewing it all up and spitting it out as a trading idea. Now, in this particular example, the initial balance range is really large due to news that came out before the market opened. So that caused an abnormally large initial balance, which made it very difficult to extend either way. So again, if you have a very large initial balance and then it pops down, but the whole average daily range has already been extended, then there's no point in you expecting that suddenly you're going to have a normal variation day on your hand, because it's quite likely that you are going to have a neutral day due to the enormous initial balance range that you have. So to summarize, if your initial balance spans the whole average daily range, which is typically what happens for high impact news that are released before Wall Street opens, such as non-farm payrolls, jobless claims, ECB rate decision, inflation reports. So because in this example, you know that the wide initial balance is there. Even if the range gets extended, you can't expect a normal day or a normal variation day, because although it is possible, because sometimes markets do go into like an abnormal trend for like maybe 30% of the time, but really it would be wise to not expect anything more than the average daily range for the profit targets on intraday. Therefore, if you see a wide initial balance, don't expect normal or normal variation day. Now let's talk through a hypothetical scenario. Remember that buying and selling tails are single letter TPOs at the bottom or the top of the profile, and they indicate aggressiveness on the other side. In this hypothetical scenario, because you have this massive J buying tail, it's the buyers. The longer the tail, the more aggressive buyers are. So let's say that you were looking for a long swing trade from some strong 4-hour demand that is located right underneath the value area for the previous day and underneath the initial balance. So here, that's your value area from the previous day, that's your open, and there's a bearish open. So you notice that the price pops down and it picks up your limit order in this J period and it breaks the initial balance. But ultimately it finds aggressive buyers who push the price back into initial balance that holds all the way through the end of the current session. Now, if you have a valid, very aggressive buying tail, which could also be visible on the price and candlesticks themselves, either as a bullish engulfing or a long buying wick, maybe even a hammer, so any one of the reversal candle patterns. In this example, we're actually coming up to the end of the London session. So now the next step would be to see where the New York session starts and whether you can get an initial balance extension to the upside. Hopefully you're following me. So you have an aggressive buying tail during London. You had a bearish open, but you have an aggressive buying tail. And then the London session ends. And then once the New York starts, then you have the next day trading time zone coming up. So if you're sitting in a long position and there's New York initial balance happening and you want to see a price go up, what do you want to see? You want to see initial balance extension to the upside during New York. So now it doesn't really matter that you had an initial balance extension downwards in London, because now you have a new session. You have a brand new session. You have New York with its own value area and with its own initial balance. So let's say that at this point we've exhausted the average daily range for the day, and now all you need to do is wait for initial balance extension during New York. And then that lines up with your post-NY cut, post-initial balance, day trading time zone. And that is an awesome setup on your hands. And that is how you time swing trades. Okay? So obviously, like I said, I mentioned the average daily range. Average daily ranges are the most accurate during New York. The next step would be to check where your average daily range exhaustion point is. On my chart here, it is displayed as these dashed lines. This is actually Blatek daily range indicator, and through a click of a button you just press A on your chart and you will get these lines. This dashed line means that that is your average daily range exhaustion point. So that falls just underneath this strong H4 demand zone, which is marked as blue thick line. And that is an H4 that says, as you can see here, we're looking at the 30-minute chart of GBP New Zealand, yeah? And then we have a strong H4 zone. This is, again, the multi-time frame supply and demand indicator from Blatek. which enables you to see different zones. By staring at M30, you can still see the H4 and the daily supply and demand zones, and it's really useful. You don't have to do it manually. This is something I used to have to do manually. Hours and hours of work. So this way, you have an aggressive buying tail during London, and that picked up your trade. And then you need to watch New York session for follow-through. So you have the information that during London, the other time frame participants have aggressively stepped in to take the price back towards initial balance. And now we're coming up to close to the 80-hour exhaustion on the day. It's no longer a great risk reward to keep shorting with the London trend. So London trend is over. Yeah, and what we're waiting for now is to see what New York session brings in regards to initiative activity. Or in other words, whether New York initial balance will get extended upside, meaning that at the time when I'm writing this, I actually have another hour and I have to wait because New York hasn't even opened yet. So this is when I would normally do gardening, practice some guitar, maybe play some Elder Scrolls Online. Do something that will occupy your time so that you don't have to stare at the charts for absolutely no reason. Like, there's no more information to be had until the next day trading time zone. So use that time to go, do, hobbies, spend more time with your kids, your pets, or, any other version of your idea of quality time. Intraday trading does not have to involve watching 5-minute charts every single second of every single day. Quite the opposite. I mean, I'm able to write books, mentor about 7 to 10 people at the same time, trade several accounts, run a website, renovate bits of the house, do some gardening, play video games, all while I'm doing intraday trading. I have plenty of time on my hands. Okay, next up. We now have break of initial balance and extension in the same direction, so sustained direction. So let's say that we're looking at the similar setup. Okay, so you have a strong demand, which is a counter trend zone. So you don't really want to trade it blind through limit orders because the downtrend is still in full force. Now this was an example of USD CAD. In this case, there was an H4 strong supply that satisfied all strong conditions, and at that time on a 4-hour chart, if you were only to look at supply and demand, it looked completely tradable. But then if you look at today's profile, you will see a different picture altogether. Price opening above value area right away, if you can see here. So we have a bullish open, above value, above range. ADR is still intact at this point, therefore we do not want to see initial balance extension to the downside. We actually want it to continue upside because you have a bullish open, you have initiative activity on the profile that is showing you the direction. And then if you look at the profile, so we have initial balance, letters A and B, and then in C period, the break of initial balance happens to the upside, exactly as expected, with the direction of the imbalance of the day. And indeed, prices start popping up. They almost touch the supply on H4, and then they briefly return to pick up some more orders and immediately jump back up. Now in this case, because the sentiment is so bullish on the profile, you have that 4-hour supply where you might want to sell, but not on this day. The reason why you don't want to sell on this day is because the sentiment is so bullish on the profile. You do not want to go against this. And then suddenly you get an extension, initial balance extension to the upside. So all the poor supply and demand traders, they're thinking, oh great, we have a supply. We're going to sell here. But you know better. You know that we have a confident extension. You have a bullish open. But you look at the profile and you know better. You know that we have a bullish profile open. You know that we've confidently extended initial balance to the upside. Okay? You know that the average daily range is completely intact, and actual exhaustion of the daily range is vastly above that strong H4 zone. And that strong H4 zone like scored super high. Now, if the price indeed stops at that zone, like on this particular day, and then tomorrow you get a bearish open on the profile, then you can go short. So this is again where you time your entries. However, on this particular day, I would only use that H4 zone as a potential target. This day actually ended as a normal variation day, and it still held well above initial balance towards the day's close. What happened eventually, we had the prices that reached that strong supply and eventually just smashed right through it. So in this case, the profile showed you the way, and like it normally does, it just gives you so much more confidence in the trades by knowing what is going on behind the scenes. You're not just blindly trading supply and demand zones as they come up. And then let's do another example of the opposing picture, the bearish picture. So here we have an open below value. And for this particular example, I just want to make sure that you understand how much average daily range is important. Because at this point, average daily range is actually exhausted somewhere around here already for the entire day. So you have an open below value. That is bearish right away. That is initiative activity to the downside. And now you need to confirm that by waiting to see whether there is initial balance exchange to the downside as well. And in fact, that does happen, and we get a very strong bear candle. But this is an intraday opportunity that is not tradable. That can happen often too. Like I can see what's happening and I know where the price is going. I know the direction, but the risk parameters required to trade the setup by the time everything lines up, it simply doesn't match the reward that you will get if you were to take the trade. Because in this case, you're maybe staring at 1-to-1 at best. So for me, that was an untradeable setup. So be aware of these untradeable setups that require stops that are way too large for intraday. And if they have less than sort of 3-to-1 risk reward profit margin due to the positioning of either because of the currently existing supply and demand areas or because of the exhaustion of the average daily range. Okay, it's very important. Okay, then we have bracketing versus trending markets. Bracketing really stands for ranging markets. It is simply a market profile term that they use. So a lot of profile traders use the term bracketing as well. What does that mean? Well, when markets go into a balance, what becomes really obvious with value areas over several days is that they start to overlap. And that usually means that the trend is waning. The price is losing conviction, it's losing momentum to keep going in the same direction. Sometimes this can mean simply a pause before confirmation, but more often it means that something has either changed or we have reached a particular area on the chart where we're expecting a reversal. So let's say that you have a weekly supply zone that you're looking at, and it happens to be a Q high as well of some sort. So you want to look at that area for potential turn in the market. Obviously, you're not going to be doing entries of a weekly area or supply and demand, but it can offer clues whether other market participants are seeing what you're seeing or whether they're thinking what you're thinking. So if you start seeing overlapping areas, overlapping value areas day in and day out, sort of over 3 to 5 days, maybe it's time to start looking to see if there's a reason for that. Obviously, you would analyze supply and demand again, maybe Q points. You would go through multiple time frames to actually see why that is happening. And once you find the reason, look for entries that will give you a setup for a reversal. Okay, because bracketing almost always means it's either a phase 1 accumulation, in which case you're supposed to be expecting a reversal upwards, or it's a phase 3, i.e. a distribution, which means that you're expecting the downward move. You're expecting phase 4, which is liquidation. So to recap, overlapping values could indicate a waning trend, loss of momentum, and a potential for a reversal. We would then monitor the market for initiative activity to the downside in order to break away from that bracket. Now, trending markets are characterized by value areas that have quite a lot of distance between them. Okay, so when something is trending, the market's open, and if the trend is still strong, the price will then open, like, this is your previous day's value, and then you would have another value that's getting created here, and so on and so on. So that is very obvious when the market is trending. But as soon as that stops, that means that there's possible change of the change of views with the market participants. So trending markets have value areas that have a lot of distance between them, and when markets open, typically they will open outside of value and outside of the previous day's session range too. Okay, so that's how you differentiate bracketing versus trending markets. Now, coming up to transitions from day time frame to other time frame participants. This is really nothing new. We've already been through all of this. This is just like a summary of all the ideas that we've been through. Now, day time frame structure always starts with the creation of initial balance range. Locals trade shorter term time frames, and they look for references that are nearby, and they don't want to take the markets anywhere else. So therefore, they trade within the initial balance and inside previous day's value. So both of those actions, so trading during the initial balance and inside previous day's value area, those are locals. That doesn't mean that if you are an intraday trader that you should try and trade that, because even with intraday we still need that imbalance, the trend even on the day. And if something is trading during initial balance, so within the value area of the previous day, there is no trade there for us, okay? There is not enough imbalance for you to get in on anything. All that's going to happen, you're going to get slaughtered. And then we have the institutions, which are visible when price breaks outside of the initial balance. That represents the other time frame participants, okay? So both of these behaviors are obviously reflected in the way the market profiles will look. When it comes to the initiative activity, when it comes to institutions, their activity on any day can range from very low to very high. That doesn't mean that as soon as you see a little extension on the profile of the initial balance, you should be jumping in, because the activity on the day can be low. Institutions don't have to trade a lot every single day. Obviously not, but you should know that their activity can range from low, medium, high on any given day. This is why you have to use your knowledge of chart positioning and trend and Q points to gauge whether this particular imprint of the institutions on the profile is worth your while or not. Now, what the other time frame participants do with the price obviously also leaves the imprint on the profile itself through the extensions of initial balance. So we will use this information to make decisions on whether a swing trade might work, or perhaps maybe you should be looking at an intraday trade because it might have more risk reward and you need to find the correct lower time frame setup to reflect the current market conditions. And by looking at the profiles and looking at this initial balance, looking at the day time frame structure versus the other time frame structure, that can tell us whether a swing trade might work. It can also tell us whether to stay in a trade or whether to get out of it. Okay? Now, differentiating between swing trades, semi-swings, and intraday trades is not as easy as it sounds, because once a trader is in a trade, typically, especially slightly less experienced traders, they are very biased and they're not very impartial. So they become biased towards the direction. So you need to try to stay objective and only read the profile without being affected by the trade that you're in. And it's a very tough ask. You know, it's you want your trade to do well. Of course you do. But at the same time, you need to not be blind to what is going on in the profile. Is it in your favor or is it not in your favor? You should strive to make a conscious decision, to make it a routine, to keep checking what the market profile is doing and to be completely impartial, making decisions on what you see and not on what you think you want to happen. Because once those two things come together, what you expect to see and what the profile is printing, and those two things are the same, then you have achieved a level of skill that's, quite incredible for trading. And then you're using supply and demand and market profile to your advantage, and a great advantage at that. Now, eventually, with lots and lots of practice, you should be able to make this into a completely automatic behavior where you kind of digest all of this information and then make a rational decision about the validity of the trade. That is really what it's all about. Looking at whether your trade is still valid or whether you have invalidation conditions. Okay? But, I will warn you, it might take 2 to 3 years to get there. Because this is a stage of unconscious competence that I spoke about in level 1. Okay, back to time frame transitions. We already know about day types. And the reason why I first teach day types, it's because knowing them is kind of the first step to reading day time frame transitions. Without knowing about the 9 day types, if I kind of try and throw everything into one lesson, the students generally find it really difficult to digest all of the information that I'm trying to cram into their heads. So I've actually broken everything into these 3 lessons of market profile. So we learn about the value area and the value area scenarios first. Then we learn about the TPOs and the day types. And only then the trader is ready to tackle time frame transitions, because it involves all 3 components. You cannot really teach buying and selling tails without knowing what TPOs and day types are. And then you cannot teach initiative versus responsive activity if you've not been through the value areas. Okay, but here's some statistical information to note. Most of the time, we'll either have a neutral day or initial balance extensions on both sides. So the 2 most frequently occurring profiles are the neutral day type and normal variation day type. So to remind you, normal variation day is when the price extends the initial balance by twice the amount of the initial balance range. So we will mostly rely on those 2 structures in order to maximize the opportunities that the market brings. Strangely enough, normal day type is not the most normal occurring profile. Okay, so moving on. So how do you know who's in control? And again, this is all a part of summary, right? This is one long summary. By looking at where the price is open in relation to the previous value area, we can then gauge whether it's responsive activity or initiative activity. So responsive activity is driven by the locals, by the market makers, and it means that the price is either opening inside value area and moving inside it, and or it is activity within the current day's initial balance. So if price is open inside value, any activity that happens inside the value area and subsequently during the initial balance too, that is called responsive activity. It's responsive buying or selling, because no major levels are being broken and prices simply moving around, trying to reach recently established levels. This includes things like yesterday's low or high. It can be a session low or a session high. It could be a daily pivot tests. Maybe yesterday's value area high or low. Point of control. So anything that has to do with balance. So if you're inside value area and they're testing the value area high or testing the value area low, but it's not enough. Like responsive activity is quite it's sort of like a part of a random walk, and there's no real move either end, and it's tough to trade, and it really shouldn't be traded. I hate trading responsive activity, and I stay away from it however I can. And the reason why I say that is I've had a few traders who were expecting a move in a certain direction. Like let's say we've reached a Q low and we're inside value of the previous day, and they're going, can I jump in without the initial balance extension on the day? And I'm like, no, please don't, because there's no imbalance of the day. Oh, please, please, please. So then I give them the go ahead for the trade. And then what tends to happen is that they spend the next 6 hours waiting for something to happen, and nothing happens. So this is why I don't like trading responsive activity. If something opens inside value, typically I will then look for an extension of initial balance, at least. Okay, next. If prices open outside value and we see continued activity in the same direction, this is then called initiative buying. That means that the market is out of balance. And once you see the market out of balance, it is usually the institutions that are making the moves. And really, since they are really the ones with pockets deep enough to move the markets, we expect to see the extension of initial balance on those days. So if market opens above value area and continues to go higher, this is called initiative buying. If it opens below value and continues to fall, eventually extending the current day's initial balance to the downside, this is both considered initiative selling. When it comes to commodities, when we're talking about institutions, like in crude oil, it's usually the commercial hedgers who are the ones who are extending initial balance and creating initiative activity. And finally, to tie all of it in, this is what we've had in this lesson. So we've had the location of price in relation to value area. Is it inside or is it outside? If it's inside, it means that we're looking at responsive activity. Outside, we're looking at initiative activity, and we should expect an extension of initial balance at some point of the trading day. Should it extend initial balance to the other side from what you're expecting to happen, either look for tails, buying or selling tails, or failing that, expect neutral day. One thing to note about the buying and selling tails, please don't go looking for them during initial balance. Initial balance has no tails. Initial balance is initial balance. So after the initial balance is established, so after initial balance, not during, there's a lot of noise in the first hour of trading, but once you have that initial balance range, you can look for buying or selling tails should the price extend in the opposite direction to what you're expecting to. And that will tell you, so how big the buying or selling tail becomes. It can tell you how aggressive or non-aggressive the other time frame participants are. On trending days, it is very possible to have a very long buying tail that then continues all the way. So it smashes, let's say we have a buying tail, so it goes below initial balance and then it continues to go through initial balance all the way up. It breaks to the upside and continues to run. If this kind of action happens to line up with one of your 4-hour or daily or supply and demand zones and you've caught it at the bottom of the buying tail, congratulations, you've caught a turn in the market. But your first clue on this happening should be that we might be outside of value area in the direction of your trade, okay? And finally, we looked at the bracketing versus the trending markets. When you notice that the value over several days have started to overlap, not just 1 or 2 days, but typically you have a whole week, like 3 to 5 days of overlapping values. If you're in a swing trade, it's time to think about booking profits and reevaluating to see if you've missed a possible cube point or higher time frame supply and demand zone, or you have to also consider that the market is creating an original supply zone or a demand zone, because that can happen too. All right, so that's it for time frame transitions. This concludes the 3 parts of market profile lessons. Now, please take your time to understand all of the concepts. Watch, rewatch the lesson, revise parts that are unclear, send me an email, ask me questions if you're not sure about something. In the next lesson, what's coming up, we'll be looking at average daily ranges and using price action around sort of conterminous lines to read what's happening. And then we'll slowly start to combine everything that we know now. And eventually we'll be forming a decision-making flowchart for the exact setups later in this course. So I'll see you in the next lesson.